Picture two retail storefronts sitting side by side on a busy city street. To the naked eye, they are carbon copies. They share the same square footage, the same brickwork, the same large display windows, and the same volume of foot traffic passing the front door. Yet one of these buildings recently sold for $500,000, while the structure right next door sold for $1 million. Beginners often fall into the trap of using residential instincts to bridge this gap. They evaluate a property based on its physical presence, asking if it looks like a nice place or a solid structure. In reality, the bricks and mortar are inert. They form an empty shell that produces zero income on its own. To find the missing $500,000, you have to look past the physical facade and dissect the invisible cash flow system running inside it. The first layer of that system is the business model of the occupier. While a residential tenant pays for a place to live, a commercial tenant pays for a place to generate a profit. Success depends on functional utility. A logistics company requires deep loading access, specific ceiling heights, and heavy-duty power to keep the supply chain moving. If the physical space lacks these operational requirements, or if a business struggles to find customers in that specific location, the tenant's ability to pay rent starts to evaporate. A building is only as strong as the business inside it. A failing tenant makes the entire investment precarious, regardless of how pristine the architecture appears. Beyond the business itself lies the true foundation of the asset, the legal paperwork. A common misconception is that a high rent check equals high income, but in commercial property, gross rent and actual profit are rarely the same. Under a gross lease, the landlord is responsible for out-of-pocket costs. A single major roof repair or an unexpected property tax bill can carve out a massive chunk of the collected rent. A robust net lease shifts that liability. The tenant contractually absorbs those expenses, protecting the landlord's revenue. This protected remainder is the net operating income, or NOI. It's the actual cash left over, serving as the definitive measure of the asset's health. A single sentence in a lease document can move financial risk from the tenant to the landlord, making the paperwork more valuable than the physical design. The strength of that lease is tested the moment a space goes vacant. Empty commercial units are cash flow drains. While the income stops, the owner must continue to pay for insurance, security, and basic maintenance out of pocket. Because these spaces are often highly customized for specific industries, finding a new tenant with the exact right requirements can take many months.
The market measures this danger through the capitalization rate, or cap rate. When a property faces high vacancy risk or has a weak tenant, investors demand a higher return to justify the gamble, forcing the cap rate up. This rate is the final factor in the price. Commercial value is determined by dividing the net operating income by the cap rate. If the risk profile causes that rate to spike, the building's price tag drops, even if the rent check stays exactly the same. This math explains why our two side-by-side storefronts were valued so differently. The $1 million building was anchored by a 10-year net lease with a national brand, guaranteeing stable income with zero landlord expenses. The $500,000 building housed a struggling local business with only 12 months left on a lease that forced the landlord to pay for all repairs. An educated buyer views a city block as a network of financial contracts and risk profiles, with the physical architecture acting merely as the container for those streams of cash. Successful commercial investing is built on hard evidence, not architectural enthusiasm. When you sign a deed, you are never buying the real estate itself. You are exclusively buying the income stream it produces.